Today, bond market to RBA put rates higher. Hello again, it's Martin North from Digital Finance Analytics, World Latest post covering finance and property news. Well, this last week, a surge in long-term bond yields drove both the Australian dollar and the local share market to 11-month lows earlier in the week. And whilst things have recovered slightly towards the end of the week, this may still force Reserve Bank of Australia Governor Michele Bullock to deliver further cash rate rises, at least according to some economists, and into expectations that the RBA may deliver one further interest rate rise is an increase in long-dated yields both locally and abroad. Long-term US bond yields galloped higher since July, alongside strong economic data and an unexpected increase in planned bond issuance to finance the US government's yawning budget deficit, which Fitch expects to be 6.3% of GDP this year. The yield on the 30-year US Treasury hit a 16-year high of 4.95% on Tuesday after the latest US job openings and labour turnover survey, or JOLTS, report showed the number of available positions rose to 9.61 million in August from less than 9 million in July. Data in the week was actually a bit more bullish, so yields eased a little bit back with oil prices, which dropped around 5% from their highs. Compounding uncertainty in the world's number one economy was news that McCarthy was voted out of the Speaker's job for the first time in the country's history, amid a spat with members of his own party around negotiations on funding the US government. But the RBA decision to leave the cash rate at 4.1% earlier in the week comes amid a rout in global equity markets, triggered by a surge in those long-dated US bond yields, which has raised expectations that interest rates will have to be higher for longer, and by the way, briefly drove the Australian dollar as low as 62.9 US before rebounding above 63 cents. On Tuesday, in the statement, one that closely resembled the final one from her predecessor, Philip Lowe, Governor Bullock said the decision to keep interest rates on hold for the fourth straight month stemmed from uncertainty about the economic outlook and signs the economy was cooling. And she said further tightening may be required depending on incoming economic data. Economists said the remarks showed Ms. Bullock was delivering continuity. NAB senior FX strategist Rodrigo Cadrell, though, said on Wednesday the weak Aussie dollar was not helped by her statement after the first policy-setting board she chaired. Although the RBA was widely expected to remain unchanged, the bank has given the ammunition to sound a bit more hawkish, given stronger-than-expected services inflation evident in the monthly August CPI and Dow productivity reading in the national accounts for the June quarter, both which have been new information over the past month, he said. The bank instead chose to deliver a message that was little changed from the previous month. Juno bank economist Warren Hogan said Australia appeared on the cusp of a new monetary policy path, one which was far more tolerant of inflation than anything seen in the inflation targeting era. The contrast between the Fed and the RBA couldn't be starker, Hogan said. The Fed is seeking to control the narrative and execute a disinflation while minimising actual rate hikes. The RBA, though, is happy to be a passenger. Political realities appear to make them unwilling to be preemptive, instead waiting to see the whites of the eyes of inflation, as one board member famously said in early 2022. Earlier in the week, financial stocks suffered the heaviest losses, with ANZ, National Australia Bank and Commonwealth Bank all dropping by more than 1.6%, while Macquarie Group fell more than 2%. And tech and community sector stocks, which are highly sensitive to long-term interest rates, were the next worst performers, down about 1.1%, following the losses from global tech giants such as Apple, Amazon and Tesla. Bond traders ascribe a 1 in 3 chance that the RBA board will raise the cash rate to 4.35% in its November 7th board meeting, and a 57% chance of a cash rate rise by December the 5th. Higher yields have crunched equity prices and caused the US dollar to appreciate against other major currencies, including the Aussie, which has depreciated a massive 8.3% against its US counterpart since mid-July, and by 4.3% on a trade-weighted basis. JB Ware Chief Investment Officer Sally Ord said the depreciating Australian dollar would not be a huge driver of inflation, but marginally adds to the inflation pulse at an unhelpful time. The currency has given the RBA no help on the inflation front, she said. And JP Morgan's chief economist Michael Knox said Ms. Bullock would ultimately be forced to raise the cash rate in response to the increase in long-dated US yields, which he said were being dragged higher by an unsustainable US budget deficit. Now, whether that happens immediately or whether that happens over the coming period is really up to the RBA and to the markets to work out, he said. And he said the magnitude of the increase in long-dated yields in the past couple of months required about 2 further cash rate increases, which would take the cash rate to 4.6%. Long-term yields have risen during the period in which the RBA has left the cash rate stable. If we want to control inflation, short-term rates are going to have to rise in line with those longer-term rates. And Vanguard senior economist Alexis Gray said her biggest concern was that core inflation was not falling fast enough. She expects 1 or 2 more interest rate rises in the next few months as evidence mounts that inflation is proving stickier than forecast. It's driven by the fact that you've got a very tight labour market. Unemployment is still pretty close to record lows. Wages are growing quickly, and although goods prices have come down, we're seeing more services-based inflation, she said. But the Reserve Bank is flying blind on the biggest risk in the inflation equation, the speed of wages growth, warned its former head of domestic markets, Jonathan Kearns. Kearns, now chief economist at Australia's largest annuity provider Challenger, said forecasting pay increases, the biggest inflation driver, was challenging because of the limitations to the data. Other complications for policymakers is the significant rise in oil prices since late August, and indeed $100 a barrel could be within sight. Given the lags between labour costs and inflation, this means we're flying blind for a while, Kearns said, before warning that high inflation episodes could take years to get under control. You can never declare victory. It's an evolving story, and it is not just in Australia, it's a global phenomenon. The wage price index, as measured by the Australian Bureau of Statistics, excludes bonuses, one-off payments and other perks that boosts labour costs. Compounding the difficulty are big swings in other pay indicators, making it harder for policymakers to discern trends. We haven't seen much acceleration in wages growth, and if that persists, then it looks like the current rate path may work out quite well, Kearns said. Outside of a wages surprise, Kearns said the cash rate has now peaked, but he wasn't always so dovish. He initially thought the RBA, where he worked for 25 years in domestic markets, financial stability and economic research, would need to lift the cash rate to 4.5% from 4.1%, where it stayed since June. But he now believes the cash rate will plateau at 4.1%, also warning, though, that it could go higher should inflation prove more persistent. And the Australian Financial Review's quarterly survey of 42 economists showed half expects one final rate increase to 4.35% this year. As for rate cuts, Kearns predicts they won't start until 2025, a view also shared by the bond markets, but not by the vast majority of economists in the survey. The survey's median forecast puts the first interest rate cut since the pandemic in play by August 2024. But the takeaway here is the bond markets are definitely going to be something which is going to drive rates higher in Australia. And whether in fact we see higher interest rates or just rates at this level for longer is the open question. But if you listen to the bond market, they want rates higher. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.